All right, what's up? Good morning, guys. I'm excited today. We have a pretty busy day, so I think we told you we bought a property. Sorry to get a sip of my coffee. Bought a property in High Point. We've bought several, obviously, if you've been watching the channel. The most recent one we closed back in June, I think. I'm gonna tell you the story about this property. Hold on, my camera's falling. Tighten all this stuff up. So we bought this property back in June. We bought it from an older gentleman who we kind of developed a relationship with. Initially when we called him, he said maybe would sell it, but we called about a different property. He said he'd sell it. And then he said he wouldn't sell any of his other ones because he was gonna give them to his children. And then what happened was we developed a relationship with him. We went and toured one of his development projects. And keep in mind, this guy's like in his mid 70s, maybe even like 80, early 80s, probably late 70s, but he just loves real estate. He wanted to keep doing it. He wanted to keep developing. And so he's just still going. And he saw that we kind of were younger guys wanting to build a portfolio. He wanted to help us out. So he was like, you know what, I will sell it. And so then we had initially asked about seller financing. He's like, no way, I won't do seller financing. Never done it, never will. I'm too late to start that now. But like I said, we developed this relationship with him, took him to lunch, and we weren't just trying to get stuff out of him. We were actually building a relationship with him because we wanted to get to know him and understand how he built his portfolio. This dude's probably worth $100+ million, old guy, super nice, super generous. Anyways, long story short, he ended up seller financing for us. So here's how we structured the deal. And this was an experiment for us. I'd heard other people talking about it, like shout out to Mike and Bo, a guy named Zachary Neal. He's like, he shadows them. We had him on our podcast and he was talking about how they do this all the time. They talk about it on their social media. Basically, they do like a BRRRR for industrial buildings. So I was like, let's try that. So we bought a building for $45 a foot in June. We got 75% seller financing and the other 25% we borrowed from a hard money lender. So the way that works is, it was $450,000. Just to keep it easy and simple though, let's just say it was $400,000. So it's $400,000 that we bought the building for, 75%, so $300,000 of it was seller financed. So the seller financed it for 3-year note, 25-year AM, 7% interest rate, which is like, about what the normal interest rate is. And the other side of it, we got a hard money loan for the rest of it. So call it $100,000. We borrowed $100,000 from somebody else at 12%, much higher interest, but that's what you do. That's what you get when you go for a higher risk loan. So anyways, $100K, second position, by the way. That's why it's more expensive. So like what that means is if we lost the property, the seller would be in first position to take the property back like he's the bank, because he is the bank. And then the person who loaned us the $100,000 would be in second position, so they have to come after the seller. So typically that's a lot riskier and less likely to be able to achieve getting that back getting your money back if something happened. The person who lent it to us though, they trusted us. Obviously we'd never let that happen. In worst case scenario, we'd just pay it out of our own pocket. But anyways, $300,000 from the seller, $100,000 from the hard money lender or private money lender, whatever you want to call it. And we came to closing with nothing. Actually, we got a small check back for like $2,000, which is crazy. I wasn't expecting that. Long story short, we bought the property for literally no money out of pocket, $0 out of pocket. That's the goal, right? So our plan is, there was a tenant there. He'd been there for a long time. He was paying way under market rent. He's been there for 20+ years, and he was paying way cheap rent. And he'd been paying the same rent for a long time. The older gentleman had never raised it on him. Unfortunately, since we got a loan, we have to raise the rent to be able to cover the loan. That's just business, and it stinks. Or I don't like that part of this business, but he had been, paying really cheap rent for 20 years. We had to raise his rent to market rent at least so that we could cover our debt payment, and then some, obviously, because we're not buying properties for them to not make money at all. We bought it. We had that conversation with him, hey, to cover our debt service coverage ratio, which is what it's called, the DCR, or debt coverage ratio. Basically just means like if your mortgage is $1,000, typically the bank wants you to have a 1.25 DCR, which in this case would be $1,025. Not this case, but the example I gave. So if your mortgage is $1,000, you need to be able to rent it for $1,250. So if you rent it for $1,250, debt coverage ratio is 1.25. If you rent it for $1,500, your debt coverage ratio is 1.5. If your debt coverage ratio is 1.25, that means your cash flow and your cash on cash is probably not going to be that great. It's going to be okay. If you do it for 1.5, your cash flow is going to be pretty dang good. And then anything above that is like gravy. So anyways, we explained to him, hey, we don't want to raise the rent on you, but unfortunately, since we have a loan, we have to raise the rent. That's just the way it is. Otherwise, we'd be losing money every single month, and that's not why we bought this property. So that conversation went well. He agreed to actually re-sign a 1-year lease because he didn't have a lease in place. What that allows us to do is, one, it gives the tenant the opportunity to see if they can, make sure they can cover the new rent. And then it gives us the ability to go and refinance out our hard money lender and the seller, because we signed a lease at market value, triple net, which is where all the value comes from. So in commercial real estate, it's valued on the income. And if it's valued on the income, then we just made a lot of money signing that one single lease. One time we signed a lease and the property's value went from around $450 to, you know, conservatively $600,000. So now we go to the bank for $600K, or we go to the bank, they get an appraisal. Hopefully we'll come in at 600 plus, and we're able to borrow 75% to 80%, in this case 75% of the value, the new value. So some banks won't do this, some banks will, kind of depends, but we're taking it to them, taking them to the bank and saying, hey, we got it in place, so it's income producing property now, it's gonna be valued on the income. And also, by the way, we didn't just go to the tenant and say, hey, we're gonna raise your rent and that's it. We said, hey, we're gonna raise your rent, but we're gonna install a new HVAC system for you. We're gonna paint your office area, make it look nicer and modern, and anything else you want us to do, we can get done. To try to, you know, one, we want the tenant to be comfortable. We're not just slumlords. We want our tenants to be happy, so we're trying to make it nice. And so yeah, we improved the property and we signed a new lease. So now when the appraiser goes out there, they're gonna say, okay, they did all this work to the building and they signed a new lease. So 75% of 600,000 is, I think, 450. So 450 is exactly what we bought the property for. So ideally, actually, it would need to appraise a little more because, you know, we bought it for 450 and then we're putting in probably $20,000 or $30,000 worth of work. So if we put in $20,000 or $30,000 worth of work, that we're gonna be all in for 480. So it needs to appraise for 25% over 480, if that makes sense. So if it appraises for that, then we'll be able to refinance, pay off our hard money lender, pay off the seller, and be in the property for $0 out of pocket at all. $0, just wild. So this is a new method we're experimenting with. If it works, we're gonna rinse and repeat this thing until we can't. Super excited about it. But that's a way to scale a portfolio with none of your own money. Long story short, we're going to meet Michael, partner in the deal. He's a contractor. He is gonna do that stuff we talked about. He's gonna paint the office area. We're gonna pressure wash the outside of the building, check on things, make sure everything is okay. After that, we're taking Michael to another building that one of our clients is buying. He's gonna get a quote on same thing, you know, small office area. They're gonna paint the office area, new floors, new lights. I'm gonna quote for that. That's for one of our clients in the brokerage world. And then later today at 2 o'clock, I am meeting a property owner who I've been going back and forth with forever on the broker and the owner. I asked if we could meet the owner because actually it's a daughter's the broker, the father's the owner. Another beautiful building near High Point, you know, gotta love it. I'm meeting that owner and the seller at the property to talk because I made an offer. Here's a little tip for you guys. And today's video is gonna be a little longer. I apologize, it's just me rambling. Let me know in the comments if you like this. Kind of trying to give as much value and knowledge. I'm also trying to focus on like just documenting what we're doing instead of creating. Sometimes I get caught up in sitting down and trying to do all this stuff, but like trying to plan out every last minute of the video. I don't know if people like that or not, but I think I'm just gonna take my camera and document what we're doing. Let me know if you like this style. But anyways, here's a tip for you guys. We saw a property, went and toured it. It was a beautiful property. It fit in our wheelhouse. It was 9,200 square feet. It's actually 8,000 square foot standalone building with a 1,200 square foot garage on 1.5 acres, fenced in, fully paved. It looks like an industrial building, but it's technically retail. They had it listed for way too much and it had been listed for a long time. So went and toured it, liked it. I gave them 3 offers. Offer number 1, $500,000 cash, which, you know, it's not cash, it's a bank loan, but cash closed relatively fast. Offer number 2, $600,000 seller financing, where you're gonna finance 90% of that 600, we're gonna give you 10%. Offer number 3 was the seller take a second position mortgage, because it's another way to get a property no money. Let's say it's 600 grand. Well, the seller would hold back 25%, so that's say 150. So you get 150,000 seller, and you get $450,000 from the bank, and the seller's in second position. Some banks will do this. So now, once again, you're in it for no money, and we talked to a couple different banks. Most of them say you need a little bit of money in it, like 5%, 10%, but still 5 to 10% getting in light is what we call it, getting in light, without, you know, putting up 200 grand. So anyways, I presented those offers. They said they were interested in the second position thing. Then they talked to their accountant. Accountants always kill deals. Said they wouldn't recommend that. And so now we've been going back and forth for a long time on this deal. I think we're close, but they keep saying they're stalling. But I was like, hey, let's just meet. Can we meet and figure out how we can work this out to where the seller gets, you know, a lot of value and benefit from this deal, and also we do too, because we want to buy this deal. We're interested. And I was like, we bought 5 others in the same area. That's what we want to do. So we got an offer on that, meeting with the seller too. And then very lastly, on Friday, I made an offer on another building, 18,000 square feet, same area, High Point. We think we can buy it for, this will probably be the most expensive we paid for a building, $48 a foot instead of 40 or 43. So we're gonna pay 48 bucks a foot-ish, around $900,000. And I think we can lease it for, it's smaller, you can chop it up in a smaller base. I think we can lease it for $6 or $7. If we can lease that sucker for $7 a foot, or even $650, I was running the numbers, $650, and the property will cash flow around $4,000 a month. So that's wild. You can't do that in residential. And we're trying to get really aggressive because, one, I think interest rates are gonna come down soon. I mean, people have been talking about it in September, interest rates are gonna drop. It's September right now. It's like September 8th or something as I'm recording this. And if interest rates drop, everyone's gonna flood back to the market. Deals are gonna be hard to find. So I'm trying to lock up a couple deals. I got one other deal I'm working on with $500,000 in Durham. It's like about 4,200 square feet, much more expensive per foot, but it's a great area and on 2.5 acres of laydown. So yeah, it's we're trying to go at it. That's 3 different buildings we made offers on, hoping to get 2 or 3 of them. If not, yeah, if we get all 3, it'd be amazing. We're trying to really change our life. That's the goal. We're not trying to do this stuff. We're obviously trying to be cautious and smart and responsible, which we are doing, but we're making sure these are good deals, but we also want to get after it. We don't want to do 1 a year or 2 a year. We want to really build our portfolio and scale. So yeah, I'll keep you guys posted as the day progresses. Sitting here waiting for Jesse at Starbucks, and we always meet like halfway between Durham and, well, he's in Raleigh, I'm in Durham, and we always meet at the Starbucks in Mebane, if you guys are in North Carolina, if you know where that's at, but because then we don't have to split off. But I'm super excited. We're going to California this week for a small bay boot camp. So small bay flex is something that we've been looking at, obviously, for City Plat. We really want to get in on a deal. Basically, it's like contractor garages. So if you see like the garages, it might be like a 10,000 square foot building with 5 2,000 square foot units, and each one is a garage door and then like a regular man door. Yeah, they're really cool. And it's kind of like multifamily, but industrial almost, because you have, 5 tenants, let's say, in that example. And each one is going to be like an HVAC company, contractor, maybe it's a plumber. These are small businesses who are just moving out of their house, maybe, or their own garage into this business front. One of my buddies, Michael, like I was talking about earlier in the video, he actually rented one in Durham, just like this. I think it's like 1,200 square feet. And it's perfect for little businesses to get their foot in the door and start. And so they're a great thing to buy. Anyways, we're going to a boot camp put on by a couple guys who are masters in the space in California. We're gonna be flying out there on Friday. Tomorrow I'm going to South Carolina to look at another deal. So it's a busy week we got going on here.
I'm in Tanger, my bad. I'll be there in a second.
Oh man, you're screwing up.
Huh?
You're screwing up already.
You didn't tell me it was Tampa.
I'm just kidding.
I said Tanger.
I'm just messing. I'll see you in a second, bud. Filming today. Let's ride. Just got Jesse in the car. This previous Friday, I mentioned that we made an offer on a building. We actually made an offer on like 2 buildings, and I was working on finalizing a 3rd, and he was like, yeah, that was aggressive. And he was like, every Friday needs to be like that. I think it's true, because if we want to level up, the most uncomfortable I've ever been, and it's probably the same for you, was last year, basically, when we were buying 2 buildings that were empty.
A year ago, that's crazy.
2 buildings that were empty, and we had to lease both of them, and we were on the hook for both of them. Literally wild. Yes, we were very pressed. Pressed and stressed. And then now we're looking on the backside, like kind of just now got everything stabilized, and so it's time to be uncomfortable again, because then that's going to push us to the next level. All right, what's up guys? I should have filmed more yesterday, I didn't get a chance to, but we ended up eating with Michael, our contractor. We did a bunch of work at Bethel, the building that we own. We got the office painted, and then the floors are getting done today. And then we also got the new HVAC installed. So like I said before, we bought that building with hard money. We did improvements. We're gonna refinance it, pull our money out, pay our hard money lender off, and we're gonna own that deal for no money. It's a new model we're messing with. Like I mentioned, we're looking at several other deals. One in High Point. We actually went to South Carolina and looked at one, and then another one in Durham, and let's see what else, the other one in Thomasville. So the meeting yesterday with the seller, I didn't film obviously because I was meeting with the seller, but it didn't go so well. I thought I was gonna be meeting with the seller. Somebody else showed up instead of the seller, the other broker, and they just talked and talked and talked. It's not very productive. I had mentioned previously that we had a couple non-negotiables in our deal. One being we wanted the right to market in our due diligence. That's something we've discovered that's really nice. If you're buying a vacant building and you have the right to market it for lease, you can get an LOI before you even close. And then you can get it financed and all that stuff, because financing is getting tougher on vacant buildings. And then also, that was one of the non-negotiables. The other one, they wanted a 5 to 10% down, non-refundable for a commercial deal. I'm like, This is a commercial deal. It is not a residential deal. Just so you guys know, in commercial real estate, you are not putting up hard money. You're putting up earnest money, which is fully refundable within the examination period. Versus in residential, there's due diligence money that goes hard and is non-refundable immediately. So anyways, didn't make as much progress as we'd like to, but we're looking at the other deal. So that one might not happen. I'm just probably gonna tell them we're not interested. If they're gonna be unreasonable. I'm about to submit it. We went back and forth on a different one in High Point. It's 18,000 feet. Went back and forth. We're very close. I think I'm about to submit an offer now. I was just finishing up the underwriting on my computer, but it's all tough. I mean, it's exciting. We have several deals we're looking at. We're trying to just be diligent and pursuing these things in a smart way, not over leveraging ourselves, and making sure we can get it done and also make our investors happy. So I'm excited. We got several in the works and I'll keep you guys posted. By the way, I got a new camera. The other one I absolutely loved, but this one's way better for video. And I think it looks pretty good.
Disrespect, so I disregard fools. All of them be facades. And they're still in the streets and they're writing statements. Oh my Lord.
So something I learned recently, it's very interesting. Typically we're trying to model our deals as 50-50. So like if we go find a deal that, let's say it's $1 million deal and we need to raise $200,000 for 20% of the down payment. Basically what we're doing is splitting it 50-50. So 50% goes to the investor brings all of the money. We do all of the work. And then, they might get a pref, so like a preferred return on their money. So if it's $200,000, they might get like a 10% pref. If they get a 10% pref, that's $20,000 in cash flow every year. And then anything after that, we'd split 50-50. So that's kind of how we were thinking about modeling our deals and stuff. But I was talking to a friend of mine who's way further ahead in investing than us. And he basically was saying, you can offer a 10% cash on cash and a 20% AAR, so average annual return. And so basically what that means is if you have $100,000 in a deal, let's just say that, and you want a 20% annual return, then you do 100,000 times 20%, that's 20K. So every year you need $20,000 returned to them. So when you sell it, so that's, let's say you hold it for 5 years, all right, 20,000 times 5, it's $100,000. So if they gave you 100 grand, you need to give them $100,000 back, their initial investment, plus another 100K. It's kind of confusing. I'm still trying to wrap my head around it. I mean, it makes sense, but actually modeling that into a deal can get complicated. So that's a nice thing about ChatGPT. So we're using a lot of our calculations based on that, because then you might not have to give up as much equity. He was like, yeah, I've done a lot of deals and I've never given out more than 20% equity, which is wild. So pretty cool. All right, that just about wraps it up. I submitted 2 offers just a minute ago. One for the deal in Durham, one for the deal in High Point. I'm going to keep you guys posted on whether or not we get those deals. And if we do, I'll walk you through them. I'm also gonna do a deal breakdown once we finish the refinance of the last deal we bought to give you an example of how we actually bought that deal with no money. Now, we haven't got through the refinance yet. The appraisal might come back a little lower than expected. And if that's the case, then we're gonna have to bring a little money to the table. If not though, and we can actually pull off what we set out to pull off, where we'll buy this deal with no money, I'll definitely give you guys the blueprint of how we did that, because that's obviously a big deal. If you can go out and buy commercial deals with no money out of your own pocket, you can scale a lot faster. So that's what we're after. We're trying to get these deals done. Hope you guys enjoyed this video. It's a little different than normal. Make sure to subscribe and hit the like button, and I'll see you in the next one.